Hi everyone, this is Dan from WealthQuest. Today I'm going to talk to you a little bit about tax planning for appreciated stock. So if you have had assets invested in the stock market for any period of time, hopefully those assets have grown in value. And that growth creates a tax problem in the future whenever those assets are sold. So we want to do our best to manage that tax impact, and there are a few strategies that we can look at. The first is to think strategically about when we sell those investments. So just like your ordinary income, your wages all have their own tax brackets, long-term capital gains, assets that you've held for more than 1 year, have a separate set of tax brackets that range from 0% on up to 23.8% for federal purposes. So we want to look at where your tax bracket is, not for your wages, but for your capital gains, and see, are there years where it makes sense to harvest at these lower tax brackets? That's the first thing we want to do. The second thing that we could always look to do is to gift those shares to other family or friends. If we're going to be doing gifting to family for one reason or another, instead of giving cash, we could give stock. This doesn't get rid of the tax problem, it just moves it to them. So they get your future tax problem, but if their tax rate is lower than yours, it's a better deal for the family, in this case, for them to pay the tax than for you to pay the tax on those capital gains. You could compare this with the third option, which is holding on to these assets until they are inherited by your beneficiaries. So when they're inherited, as compared with gifting, when they're inherited, the beneficiaries get a step up in the cost basis, which means whatever the value of those assets are, when you pass away, that becomes their new basis. So all that prior appreciation is gone, and they could turn around and sell those assets after they're inherited for no capital gain. So the fourth and kind of final thing that you could look to do with these appreciated shares is to donate these to charity. So the benefit to donating to charity is you do get to claim a deduction up to the fair value of what you have donated. So all the appreciation, you never end up having to pay the tax on that. So even if you end up claiming the standard deduction and you don't get to itemize your deductions, you don't get to claim charitable contributions, you still avoid all the capital gain that you otherwise would have had if you sold those assets, paid the tax, and then donated that amount to charity. So there are a number of things that can be done, some of it strategic to the timing, some of it depending on where you want those assets to be given or donated. So you can always talk to your advisor, look at your investments ahead of year end, and see if you want to do anything to take advantage of these capital gains.